Great. So we'll record so that we can be able to share. I hope you can see the screen.
I can.
So the taxation of business income. Let's see what happens here. So remember what we said, just a recap what we mentioned in our last class. We said that for an income to be taxed in Kenya, services must have been rendered in Kenya, income has to have been earned in Kenya, payment of services must have originated from Kenya. But we had some exemptions. For a resident who is an individual, employment income will be taxed in Kenya regardless of its source. And of course, the same for the business income, as long as it's a resident. I'm not sure if we saw the difference between a resident and a non-resident. If we didn't, I think I have some recording I'll be able to share on that one. Let's now go deeper and talk about taxation of business income. And we can summarize by saying it involves a scrutiny of the income statement, of the firm to ascertain whether it was correctly computed. I.e., number one, if all taxable incomes were added. So all the incomes that are supposed to be taxed for that business, were they added? If all taxable incomes were added, if not, we add. So number two, if all allowable expenses of the business, if all allowable expenses were deducted. Allowable expenses are basically the genuine expenses. The correct expenses of the business. So if all allowable expenses were deducted, if not, we deduct. And most notorious example that is never deducted is what we call capital allowances. Capital allowances is the depreciation. Accountants call it depreciation. This is what we're taxed naita capital allowance. So the accountant will deduct depreciation instead of deducting capital allowances. So we are certain if such mistakes happened. If such mistakes exist, then we correct. The only way to correct is to deduct. In simple terms, what we are saying that when computing the business income, we do some corrections. It is not our responsibility to prepare the financial statements of the company. That responsibility is for the accountant. Sisi kama watu wa tax, we only come in to check if the accountant did the right thing. And how do we check? By evaluating most of these. All the incomes that are part of that income statement, are they taxable incomes of the business? If the answer is no, then we have to remove them. If there is any income that was not genuinely added, we simply add. Number three, all non-taxable incomes and non-business incomes were omitted. If added, we deduct. Remember, incomes increases the profit. So kama kuna income iliongezwa na ifaa kuongezwa, tunaitoa kwa kudeduct. Then of course number four, all disallowable expenses. All disallowable expenses were omitted. Those are the wrong expenses. If deducted, we add back. If deducted, we add back. The number 5, if accounts were prepared as per the requirements of Income Tax Act. So that is our role, to see if the 5 were followed. So according to the Act, we are writing, according to the Act, number A, an income is either taxable or non-taxable. Income iko tu na jina mbili, either a taxable income or a non-taxable income. The number B, an expense is either allowable. Allowable ni sawa na deductible, or disallowable. Disallowable ni sawa na non-deductible ama non-allowable. So tusisikie mahali mtu anasema that this income is allowable, hiyo si tax. Sijui hii expense iko taxable, hapana. Income iko tuna majina mbili. It's either a taxable income if it's a genuine income of the business, or it's not taxable. Expense pia iko tuna majina mbili. It's either allowable expense or disallowable expense. As simple as that. So I need to know taxable business incomes. Taxable business incomes include number 1, sales proceeds from the normal transactions of buying and selling activities. Sales proceeds from the normal transactions of buying and selling activities. So that is an income. Hiyo ni income ya kawaida. The proceeds that you are getting from the normal proceedings, na nimenunua goods nikauza, hiyo ni income yangu. Another taxable business income is discount received. Obviously hiyo tunajua. Na hapo mbele tumwambie kwa discount allowed is an allowable expense. Discount allowed is allowable expense. Number 3, we have foreign exchange gain. Foreign exchange gain if realized. Very important. Foreign exchange gain if realized. That part of if realized is very key. And examiner will always tell if he's silent in taxation, you're allowed to make assumptions. Can assume realized or unrealized. Foreign exchange gain. So the gain from the foreign transactions, if it was realized, it becomes a taxable income. Now, foreign exchange losses. Foreign exchange loss is allowable expense. Is allowable expense. Hii pia if realized. Great. Wakisema unrealized, then hiyo ikui taxable. If it is unrealized, it's not taxable. But if it is realized, it is taxable. Very important. Another taxable income. We are looking at another taxable income. We can have insurance compensation. Insurance compensation on loss of revenue items, e.g. stock or sales. That becomes a taxable income. Insurance compensation on loss of stock. Then of course, insurance compensation on capital items is a non-taxable income. E.g. loss nini e.g. So basically capital items, this one you can just mention them here. So capital items that we talk about are the fixed assets. Fixed assets. On the loss of fixed assets, so like now unapata tulikuwa tumeinsure a house ikapata the maybe by fire ikachomeka, insurance imecompensate. That is not a taxable income. That's a capital related compensation. So don't pay. That's not a taxable income. But if we had insured our stock, sorry, kelele kidogo. If we had insured the stock and the insurance and we lose the stock, insurance company compensates us. Then that kind of compensation in other ways, like saying we have made a sale. That's like a sale that has been made. It's as simple as that. But if we lose our motor vehicle is a capital item, that's a fixed asset. When insurance company compensates me, then it's a polite way of saying I've sold a motor vehicle. When you sell motor vehicle, you don't take it in the income statement. That is a balance sheet item. So that is very important. Insurance compensation must be on revenue items, stock, sales, that one, for it to be taxable income. But again, insurance premiums, insurance premiums paid for both revenue and capital items is allowable expense. Is allowable expense. Kumbuka, the items must be for the business. Let's have one more. We have one called trading receipt. Trading receipt and balancing charge. Trading receipt and balancing charge, that is a taxable business income. Then we say it arises when all assets in a class of WTA. WTA is wear and tear allowance. It's like a depreciation. All assets in a class of WTA are sold at a profit. The most important thing here is that we are selling all assets, not just a few. A class of WTA, we shall see those classes. We have two classes of WTA. If all assets are sold at a profit, the profit is trading receipt. Trading receipt. If business is continuing, that's the difference. And a balancing deduction if business is ceasing. So if business is coming to an end, we call it balancing deduction. If business is continuing, we call it trading receipt. As simple as that. Great. Then under the same, what if we sell we sell those assets at a loss? If all assets in a WTA class are sold at a loss, the loss is called trading loss. If business is continuing, and a balancing deduction if business is ceasing. And of course, the loss is allowable deduction. The loss is allowable deduction. If business is continuing, it's called a trading loss. If business is ceasing, it's called balancing deduction. And either way, this loss is allowable deduction. So if we sell the assets at a gain, ni kama ile tu ya capital gain. Capital gain, we are selling them at a profit. Capital loss, we are selling them at a loss. Yeah. Then maybe we have something to do with the points to note. NB, NB number 1, opening stock, and purchases have an indirect relationship with profit. They have an indirect relationship with profit. What do we mean? If they are overstated, profit is understated, and vice versa. So the opening stock and purchases, hizo zinacheza inverse relationship. Zikiwa overstated, profit inakuwa understated. Zikiwa understated, profit inakuwa overstated. So in the same concept, closing stock and sales have a direct relationship with profit. So any direct relationship, if overstated, profit is also overstated, and hence we deduct to correct the profit. I'll explain. We deduct, correct the profit, and vice versa. Now, what are you talking about here? Remember we said that the computation of business income is not about preparing the preparing the P&L. Hapana, we already have the P&L that has been prepared by the accountant. Now you're only coming in to check if the accountant did the right thing. In preparing those financials, did the accountant include all the incomes? Did he include all the genuine incomes, all genuine expenses, or there are some expenses he excluded, or she? So that's why we're coming in to correct the mistakes. In correcting those mistakes, we might find that he overstated the opening stock. If he overstated the opening stock, then that basically means that even profit is understated. And remember, we are correcting the profit. So if opening stock is overstated, profit is understated. So in such a case, we shall add back. Opening stock and have an indirect. If they are overstated, profit is understated. We can actually put this one here, is understated. And if the profit is understated, meaning report profit kidogo. So we add back. We add back the understatement. We add back the overstatement. We are adding back the overstatement to correct our profit. So if the profit, so if the opening stock is overstated, profit is understated, meaning they have reported a lower profit. So we have to increase the profit to correct the mistake. So the closing stock and sales, they have a direct relationship. If they are overstated, profit is also overstated. And if the profit is overstated, we have to reduce because it is in excess. Point note number 2. Point note number 2, bad debts. Bad debts. Then for bad debts, they are of two types. We have two types of bad debts, i.e. specific bad debts, and general bad debts. Specific bad debts and general bad debts. Now for KRA purposes, we don't like general figures, we like specifics. We like specifics. So if it logs us out, we just rejoin using the same link. We like being specific. You don't just come up and say a blanket figure that 10% of my customers are not able to pay, so I had to write them off as bad debts. No, that is a general figure. We do some specification. Be specific. Say a debtor called Wafula was not able to pay, and we had to write it off as bad debt. That's the specific. And with that explanation, inamaanisha kuwa with the specific bad debts are what we want. So if they are what we want, and we know that from our basics, bad debts are expenses if they increase, their incomes if they reduce. The expenses if they increase, so let's say something on that. So we say for bad debts, increase in specific bad debts, increase in specific bad debts is allowable expense. Increase in specific bad debts is allowable expense. Sorry. So increase in specific bad debts is allowable expense, while decrease in specific bad debts is a taxable income. Increase in specific bad debts is allowable expense, while a decrease in specific bad debts is a taxable income. So specific ndo tunataka, ziki-increase hiyo ni expense, ziki-reduce hiyo ni income. Nice. The next point we say, increase in general bad debts is disallowable expense. Increase in general bad debts is disallowable expense, while decrease in general bad debts is a non-taxable income. While decrease in general bad debts is a non-taxable income. So very important, general bad debts hizo ni mbaya. Ziki-increase, disallowable expense, ziki-reduce, non-taxable income. Point note number 3. All provisions are disallowable expenses except provision for specific bad debts. Provision for specific bad debts. That's the only provision that is allowable. Nasikia sijui provision for salaries and wages, provision for taxation, provision for management fee. Hizo zote ni kelele, disallowable. The only provision that is allowable is a provision for bad debts, specific bad debts, not even general. Provision for specific bad debts. I really insist on this specific, because bad debts, we have two types of them. If it's a provision for general bad debts, it also becomes disallowable. Great. So point note number 4, point note number 4, gain, gain stroke proceeds, gain stroke proceeds on sale of fixed assets, on sale of fixed assets is a non-taxable income. Watu wanakuambia gain on sale of assets, the company sold some assets and made a gain of 20,000, proceeds on sale of assets, yote non-taxable income. And of course, with the same concept, loss on sale of fixed assets, loss on sale of fixed assets is a disallowable expense, is a disallowable expense. So for the accountant, in normal circumstances, accountant will put these, the gain on sale of assets ataweka kama income kwa income statement, the loss on sale of assets accountant ataweka kama expense. But now those are the corrections that we have to do as tax people. We have to take note of that. And I think with that one, now we should be able to have with that concept, scrutinize vizuri, tunafaa tukuwe in a position ya kupeleka sasa kwa income statement, kutengeneza income statement. Maybe just something else to add, depreciation is disallowable expense, while capital allowances or deductions, capital allowances or capital deductions are allowable expenses. Sisi tuna allow capital allowances, lakini tuna disallow depreciation. Depreciation is for the accountant, capital allowances or capital deductions are for the tax people. Great. Let's see if we can get just to try and analyze maybe one question. That's looking at maybe a question that has the accounts have been prepared. Mm-hmm. Because questions on partnership are very notorious, we just we write something small that is unique on the partnership, like a small subtopic, taxation of partnership business. Taxation of a partnership business. Then under that, we can just say briefly, a partnership is saying that a partnership is never taxed. A partnership is never taxed. Why do we say that? It is the respective partners, who are taxed who are taxed on income from the partnership.